Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Sean O'Hara, president of Pacer ETFs Distributors, to discuss an ETF that provides exposure to 100 higher quality emerging market companies. It's great to see you again, Sean. Let's start with the macro here. What's your general market outlook due to the Fed's posture on raising rates and inflation?
Well, thanks for having me. It's good to see you, Jill. I think this morning's a great example of, how important the Fed's policy and their stance is. I mean, we had this big liftoff that appears to, or that people seem to be crediting with, some rumor that the Fed's going to, not necessarily pivot, but pause. And so, that tells you that the market knows that if interest rates continue to go up, as the Fed has said they're going to, that will slow the economy down, and that will eventually trickle through to corporate earnings. And so stocks have been under pressure all year for that reason, and because inflation has been relatively high. There's an inverse relationship between interest rates and inflation and market PEs, and we've seen them come down. So I think my outlook is that you have to watch two things or three things very, very carefully. One is you have to watch the Fed, because they're going to tell you a lot. If they don't pause, then we need to start looking at what guidance looks like going forward in terms of corporate earnings. And we're starting to see some negative guidance. And then the last thing I think that you have to pay attention to is the unemployment rate. That might be, the Fed has said they're not necessarily going to come to the rescue of the market, but they might come to the rescue of the job market. And so if their policy is effective as it's designed, which is to slow down the economy, to create demand destruction, to try to tame inflation, but they do so at the expense of costing people their jobs and increasing unemployment, that's their other mandate. And so those two things will conflict. So I think it's time to be careful and to have lower PE portfolios as opposed to the high flying growth names that historically have led us the last 10 years or so.
What types of strategies can mitigate risk in these types of environments?
Well, I mean, one we have with you guys at Nasdaq, we have a version of the Qs that's a trend following strategy, PTNQ. And essentially what it does is it employs a 200-day moving average to the Nasdaq 100. When the Nasdaq 100 is above that moving average, we own the Nasdaq. And when it starts to fall below, as it has been all year, we start to move away from Nasdaq and go into T-bills to try to, to mitigate some of that downside risk. And so that's one way investors could mitigate the risk, is by having strategies that are designed to do that, that one thing. The other way, and we've seen a lot of financial advisors do this, and I know this is on our list to discuss today, but we have a series of ETFs called cash cows, which use free cash flow and free cash flow yield. And they generally have a much lower overall PE than the market, single digits, for example, as opposed to the market still being at 18 times. If we're going to see persistent inflation and interest rates continue to rise, PEs will come down further. They've come down a whole lot already. And so they likely could continue to come down if the Fed stays the path. And what free cash flow does for you in an inflationary environment is it gives you a current return on your money, as opposed to waiting for future earnings to accumulate in an investment that might be more growth oriented. So that's another way that investors could potentially mitigate risk in this environment.
What about emerging markets?
We have an ETF, ECAL, which is part of our CAL series that, as you mentioned, it's 100 stocks pulled out of a broad base emerging markets index, screened for free cash flow and free cash flow yield. That 100 stock portfolio today is trading at like 5 times earnings. It has a free cash flow, and I had them check it because I didn't believe it. It's got a free cash flow yield of 46%. So to put that in perspective, like, free cash flow yield is the free cash flow a company generates divided by its enterprise value, and enterprise value is market cap plus debt minus cash. So these companies that we own in that ETF, ECAL, could essentially buy back all their stock and retire all their debt in 2 years with the 46% free cash flow yield. So on a historical basis, the emerging markets in general are very, very inexpensive, but ECAL, with those 100 stocks that are all profitable and have high free cash flow and free cash flow yields, are really, really cheap historically. Now, the downside is that what's really keeping the emerging market stocks down is the dollar. The dollar has been one of the stronger currencies globally. And if that reverses itself, that makes those emerging markets economies and the products that they sell here more attractive. And so I think, this might be for somebody who's a long-term investor, or for somebody who's already allocated to emerging markets and is frustrated. They might be able to take, for example, a tax loss and reposition that portfolio. Like if you owned EEM as an example, which is just a broad-based emerging markets index ETF, it might not be a bad idea to start looking at that for the long run, knowing that, you could see some continued short-term volatility and maybe even some potential downside. But over a 5 or 10-year period, when you get a chance to buy stocks like what we have in that portfolio, as cheap as they are, you don't get those chances very often. And so we don't talk a lot about that as an industry. We're always tend to be more focused on large cap US because we're all Americans. But emerging markets on a historical basis appear to be very, very inexpensive relative to what they typically trade at.
And you had mentioned the US dollar is really what is applying pressure to many of these companies. What do you think it will take to tamper the movement that we've seen in the US dollar? Is that just a shift in Fed policy?
That could be it. The big drag on the dollar, I think, is the flight to safety across the world. So, as these, other countries who might be in, say, a little bit worse economic shape than the United States, those investors over there don't want to buy government bonds over there. They can buy our debt here and have a quote unquote stronger currency and maybe even get paid a little bit more interest. The interesting thing about the dollar is that the dollar is really linked to oil. And so what's really keeping the dollar strong is our flawed energy policy here in the United States, where we're just punishing people who want to drill for oil. We should be trying to produce as much oil as we can here as opposed to outside the United States. And if we were to do that, that would drive down the price of a barrel of oil. That would help with inflation. And then that would ease the dollar as far as its strength, because all oil contracts globally are traded in dollars.
All right, Sean, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you for having me.